So let's head on over to the CME Group, where the Senior Vice President and Portfolio Manager of Kingsview Asset Management is standing by, Mr. Paul Nolte. Good morning to you on a Friday. Let's get right into market reaction to. Let's begin with the dollar, because I'd imagine it's going to be an interesting day for the dollar with rates coming off. And it seems like the dollar is starting to get wind of the fact that rates are into multi-year lows, Paul.
It is, and I think, too, the other part of it that's getting interesting, we noticed that in the overnight trade, when the announcement was made about the tariffs for Mexico, is the dollar came off significantly. And it's recovered some here, but I think what we're reading into that, and one of the things that we're looking at, and you alluded to it in your discussion on gold, is confidence in the U.S. And that is starting to wane here a little bit as everybody kind of looks at the United States as backing out of an agreed upon deal. And so now the confidence in, if I have a deal with the United States, that doesn't mean I have a deal with the United States, because that can change on a dime. That lowers the overall confidence in the U.S., and that gets expressed in the dollar, and it's getting expressed in gold here a little bit. So I think what you're looking at is maybe a peak for the dollar around that 98 level. We hit it yesterday. We've come off here a little bit. We still think 100 is doable, but 98 right now may be the current ceiling for the dollar.
Yeah, it's interesting to watch the dynamic between rates and the dollar recently. The dollar and some of the currencies that you and I have talked about, especially the euro and the British, and really some of the characteristics associated with that dollar rally. It's not uncommon to see it into a new high, pull back a little bit, but the pullbacks are limited in terms of real price decay. But Paul, I want to get into the indices and the reaction to. Let's pull up a quick look at the actual data so our viewers at home can see the numbers that just came out. Again, I mentioned the fact that they were in line with expectations. We talked about that core PCE at 0.2. Look at the personal income, 0.5, a little bit higher than expected. Consumer spending came in just a bit higher than expected as well, and that PCE price index at 0.3, I mentioned in line with expectations. Paul, looks like the indices are getting a little bit of a lift. I'd imagine that's going to be a bit encouraging to the bulls, considering, well, it looks like inflation is still not really a major concern. And I mean, ultimately, again, this is really what they're looking for, trying to help us kind of recover from some of the trade tariff concerns. We're coming off lows right now.
Yeah, and then for us, one of the biggest things is the spending number. Certainly the income number above spending, which is a good thing. We're saving a little bit more. Yeah. But the spending number was pretty good. The spread is pretty much in line. And now we were looking at, we looked at it yesterday. The Fed futures projecting 3 interest rate cuts by the Fed by this time next year. So we're now expecting the Fed to be very active, and probably the first cut coming before September, according to the Fed funds futures markets. So things have unraveled rather quickly from the beginning of the year, when everybody was talking about a Powell put, and that the Fed was stepping aside here and allowing the markets to rally.
Yeah, that's not the only unraveling. You actually commented earlier on some of the unraveling of confidence in terms of American policy and our approach toward trade negotiation. The latest trade concerns, Paul, does it just compound the already existing trade concerns, or is this a horse of a different color? Is this more easily resolved than the U.S.-China trade talks?
I wish I knew. But it's showing up in the trade figures. Global trade has come off significantly. We're seeing it down 3 to 5%.
Wow.
Both imports and exports around the globe. So it is something that's being impacted. There was some commentary yesterday that we read that was actually very interesting in how to take a look at the China-U.S. trade and then how to handicap it. Essentially, we're playing a game of chicken. And how do you handicap a game of chicken? You really can't. And that, I think, is really the frustrating part of looking at the markets and trying to discern it. It's an on or off switch. And that's where we're at right now. And it's part of the reason why I think we're seeing the big moves in the markets across the board, not only equity markets, treasuries, because these have long-lasting impacts. If the deal were to sign tomorrow for whatever reason, it would take months before we see a normalization, as a lot of companies have already gone to new supply chains, et cetera. And it's going to be difficult to walk that all back. even if we signed a deal tomorrow.
Yeah, that's a good point, Paul. Again, this could be a long, drawn-out trade discussion process, but even once we get a deal, getting back to normal could as well. Paul, this week, we saw rates move lower. It's been attracting some attention, to say the least, as investors and traders have been forced to kind of take a step back and notice. But I wonder, has it forced the Fed to do the same thing? Paul, can the market drive Fed policy? If rates keep moving lower, is the Fed going to be forced to cut?
I think the market is forcing the Fed's hand. We listened to Clarita yesterday, one of the Fed officials, and said that, the economy's in a good spot. So he was talking that we're not ready to move on rates at this point. They're very comfortable where rates are right now. The markets, I think, are moving a lot more on concern over trade and a global slowing. We're not seeing it just in the U.S., but we're seeing it around the world, where a lot of the economic numbers have softened. The recession risks in the United States have picked up significantly just since the first of the year. The yield curve, which we always talk about, is now inverted from 1 year in, so 3, 6, and 1 year, actually higher now than Treasury yields out to 15 years. So we've got an inversion. It's been that way now for the last 2 weeks. Again, a sign that a recession is somewhere on that horizon, but it's approaching as opposed to further out.
Paul, I think that's the loudest I've ever heard the background behind you since we've been having you on the show here. There must be some energy down there today, I'd imagine. Let's talk a little bit about the peso and the impact that some of the news last night could have on the 6M.
Yeah, they are getting rather excited here. It's been that way for a while, and I think with the markets moving around, we've seen the markets move 50, 60 points on the Dow just as we've been sitting here. When you look at the peso's been trading in a fairly wide band. The move down in the peso last night in reaction to the tariff discussions puts it toward the bottom end of the range. And what that does is obviously makes Mexican goods much cheaper for the global economy and allows them to trade not just with the U.S. but around the world at a much cheaper price. So that it is the immediate impact. We saw it in the dollar as well. So we're seeing a reaction in the dollar and a lot of the cross currencies. I'm going to be interested to see how the day unfolds and what we hear from Washington and some other things that may go on. Not that we're going to roll back all the way, but I think calmer heads will prevail, say about 2 o'clock today. And we may see a little bit different picture than what we're experiencing this morning. Yeah,
it could be a complicated end of the day with month-end activity as well. One more question for you, Paul, and then we'll let you get on with your day. The USMCA Canadian dollar impact right now. I mean, you mentioned the Mexican peso. We took a look at that. The 6C, though, already struggling to find some footing, and it's also got crude issues to deal with. If it continues to come off, I'd imagine all of that's just going to weigh on the Canadian dollar as well.
It is, and I think crude, as we talked about a couple weeks ago, crude is experiencing issues both from a supply perspective as well as demand and a global slowing story. So I think crude is reacting to a variety of fronts here, certainly not helping the loonie, the Canadian dollar. And so I think we're stuck with, again, when it comes back to the discussion on the dollar still winds up looking relatively strong relative to everything else. But even that is starting to come off as investors, again, as we talked about earlier, maybe starting to lose a little bit of confidence in the U.S. and how they're going about negotiating deals. So this could all unravel rather quickly, and that spells a lot of trouble for a lot of markets, especially the U.S. equity markets.
Awesome, Paul. Really appreciate you joining us here and sharing your thoughts this morning. That's Paul Nolte, the Senior Vice President, Portfolio Manager at Kingsview Asset Management.